All right, welcome to this explainer, where we're going to completely unpack exactly how the global ultra-rich invest their capital, and specifically why they're making these complex, billion-dollar bets in India. If you've ever found yourself wondering how massive institutional funds and trillion-dollar family offices actually decide where to park their mountains of cash, well, you are in the exact right place. We're going to break down their unique mindset, their relentless obsession with risk management, and exactly how they navigate what is arguably one of the most complicated yet highly rewarding markets in the entire world.
So, here's our agenda for today. We'll kick things off with the mindset of the ultra-rich, trace what we call the global wealth gangotry, explore India's promise and peril, unpack the Hotel California trap, ask about missing global Indian brands, and finally, look at exactly what it takes to be winning in India's chaos.
Okay, part one, the mindset of the ultra-rich and why it goes way beyond just having insider information. Let's see what actually sets these folks apart from your average retail investor. Now, you might be wondering, do these massive institutional investors and ultra-wealthy families just have insider secrets that the rest of us entirely lack? I mean, it's a super common belief, right? We tend to think the wealthiest people are just operating on hidden tips. But the reality? It's actually much more grounded in brutal discipline than in some kind of secret knowledge. Yeah, so the ultra-rich definitely do not rely on magic secrets. Their actual edge is a combination of immense patience, a really sharp ability to get down into the nitty-gritty details, and a consistent track record. Because they're sitting down with successful entrepreneurs and top-level policymakers all the time, their sources of information allow them to read macro trends so much better than the average person. They are superb listeners, they have fantastic memories, and most importantly, they have the sheer tenacity to dive deep into the absolute granular details of every single deal. And this right here illustrates their core philosophy. Because they know just how incredibly difficult it is to actually make money, their very first instinct is to aggressively protect what they already have. For a truly evolved, ultra-rich investor, the goal isn't just about maximizing high-risk bets. It is all about capital preservation. They deeply understand that to stay wealthy, you first have to make absolutely sure you don't lose the wealth you've already fought so hard to build.
Moving right along to Section 2, the global wealth gangotry, the true source of institutional trillions. Let's see how this protective mindset scales up into massive pools of wealth.
To really wrap our heads around the sheer scale of the capital we're talking about, just take a look at this massive figure, over $1 trillion. That represents the size of just one single country's savings, Norway's pension fund. When you have this much capital, you literally cannot invest it all in your own country. It's impossible. You are forced to hunt the globe for new opportunities.
So think of this as a massive flowing river of cash. This immense global wealth flows from four main sources. You have sovereign wealth funds, which are essentially the profit and loss surpluses of entire nations. Then you have pension funds, holding the retirement savings of everyday citizens, compounding over 40 years. You've got insurance companies, sitting on massive daily inflows from life insurance premiums that they simply have to invest somewhere. And finally, endowments, like massive charitable foundations. This is the global gangotry, the ultimate source from which all major investment capital flows out into the world.
All right, Section 3, India's promise in peril. Let's transition into examining why these massive wealth pools choose to flow into India, weighing the incredible promise against the very real perils.
Let's think about exit strategies for a second. Look at the difference here. Public markets offer an easy exit button, whereas private markets demand intense due diligence and local expertise to navigate safely. When global sentiment shifts, say because of a new trend in artificial intelligence, a public market investor can easily sell their shares and just take their money out. Bam, done. But in the private markets, like real estate or private equity, that money is locked in. Investors absolutely must have local feet on the ground to understand the shifting winds of the local landscape. And despite the obvious promise of a massive consuming population in India, foreign investors constantly worry about macro risks. We're talking oil-driven inflation, sudden policy flip-flops, and currency depreciation that can just devour their profits. For instance, India imports about 75% of its energy. So if global oil prices spike, local inflation rises, which directly hits the spending power of the Indian consumer. Then there's the currency risk. Imagine making a fantastic 20% return in rupees, but the rupee depreciates against the dollar. Suddenly, your actual net return taken back home might drop to 13%. And of course, there's always the fear of sudden policy changes, like overnight bans or retroactive taxes, which can literally wipe out a billion-dollar investment in an instant. I absolutely love this analogy. Fund managers literally pull out differently colored currency notes to prove to investors that India isn't just one big monolithic market, but rather this deeply complex web of varying languages, tastes, and hidden systems. In fact, many global investors are told that India operates much more like 22 different countries, all stitched together. I mean, even clothing colors or beverage preferences shift entirely depending on whether you're in the north or the south. You absolutely cannot manage these investments from a cushy office in Hong Kong or New York. You need a dedicated local team that understands the hidden heartbeat of every single city.
Which brings us to part 4, the Hotel California trap. This is a major structural hurdle in the Indian market.
You know the song lyric, right? You can check in anytime you like, but you could never leave. It's catchy, but it actually perfectly encapsulates a major fear for foreign capital in India. It is incredibly easy to bring money into the country, but due to heavy regulations and legal friction, actually extracting it is notoriously difficult. Now, while this is partly a perception issue today, it's firmly rooted in historical regulatory realities where getting your capital back out, especially in private markets, means navigating an absolute maze of legal and operational challenges.
Take a look at this huge number, 8,500. That represents the total volume of listed companies currently residing in the Indian stock market. Many of these entered decades ago, back when IPOs were practically the only way to get capital. Before venture capital really existed in India around 1991, if you wanted to build a factory, your only real option was to get a bank loan and do a public issue. Because of this, thousands of companies got listed. And because taking a company private in India is exceptionally difficult, they simply remain listed forever.
But here is the shocking contrast. Out of those 8,500 companies, only a tiny fraction, maybe 200 to 300, actually maintain the global governance and transparency required to be considered a safe bet. That is exactly why valuations for this tiny, high-quality group absolutely skyrocket. When you filter for strong management that doesn't mix personal expenses with corporate funds, you are left with very few options. So all these massive global wealth pools we talked about, they are all chasing this exact same tiny group of premium companies. All right, Section 5, Missing Global Indian Brands. With all this capital flowing in, why is India still focusing inward?
So you've got to ask, why are there so few truly global Indian tech or consumer brands? Well, this timeline kind of spells it out. It reveals the root cause. India's historically protected economy lacked competition, and even though recent venture capital has absolutely flooded in, it takes serious time to build a culture of deep, global-facing innovation. Before 1991, industries were artificially protected. Without foreign competition knocking on the door, there was honestly very little incentive to aggressively innovate or invest heavily in research and development.
And the contrast here is just striking. While companies in places like Taiwan and South Korea were forced to build for the entire world, Indian startups have naturally prioritized the immediate, massive demand of their own domestic market. Think about it. If you're an entrepreneur in South Korea, your domestic market is way too small to build a massive conglomerate, so you are forced to build hard tech for the globe from day one. But in India, an entrepreneur can look at a population of 1.4 billion people and say, hey, I just need to solve a local consumer need right here. The domestic market is so vast, it literally acts as low-hanging fruit.
Okay, final section, part 6, Winning in India's Chaos. Let's zoom all the way down to a micro-level case study.
Let's see exactly how smart money navigates this complex chaos to secure a massive win. Back in 2006, Smart Institutional Capital bet this exact sum, 234 crore rupees, to fully acquire a commercial real estate building project in Gurgaon, Mumbai. They were taking on significant risk, but they saw that international software companies were desperately looking for office space, and they decided to fund the creation of a massive 800,000 square foot building.
Now, how did they pull this off? They protected this massive investment through incredibly strict fiduciary discipline. Initially, they considered a 50-50 joint venture with the developer, but they realized that in such a complex market, complete control is the only way to prevent future disputes. So they just bought the whole thing. Later, a major multinational tenant verbally agreed to take a floor, but they kept dragging their feet on signing the actual paperwork. So what did the fund do? They canceled the agreement. In a market totally built on informal relationships, this caused a massive uproar. But the fund managers were upholding a strict fiduciary duty to their global investors. And because they held their ground, they were able to lease those exact same floors at significantly higher market rates shortly after.
And what was the result? 2.2x. Ultimately, that highly disciplined, on-the-ground approach allowed the fund to return more than double their initial investment over roughly 7 years. They spent around 234 to 236 crores and eventually sold the asset for 525 crores, pulling out another 100 crore through lease rental discounting on top of that. It perfectly demonstrates that while the Indian market has vast, sprawling complexities from regulatory red tape to hyperlocal market nuances, the rewards for navigating it with immense patience and true local expertise are absolutely extraordinary.
So based on everything we've unpacked today in this explainer about the billion-dollar bets of the ultra-rich, I want to leave you with this question to consider for your own financial journey. Knowing all of this, will you focus on pure capital preservation, or will you do the granular, on-the-ground work required to capture those massive rewards in complex environments? Thank you so much for joining us, and keep pushing your understanding of how the world's capital really flows.